Hey everybody, the point of this video right off the hop, what I'm going to explain is Lemonade is going to spend a lot of money on growth. A lot of money on growth spend to maintain their current book of business and also aggressively grow their book of business. They're doing that already, and that's only going to expand in the coming years. But even if you think about that, quantify that, which we're going to look at and explain in this video, you can still justify within that a share price of over $100 a share. So that's what we're going to dig into in this video, because I've seen a few people talking about, maybe by 2030 they'll be spending $200 million a year, $250 million a year on growth spend, etc. It's like, and I've seen some way too conservative numbers in understanding probably what they're going to have to spend. But I want to realistically try and explain, look at the growth spend, where it could go, and then also show again, hey, even when you're factoring that in, it still could be worth $100+ per share right now. So growth spend, which is a portion of your sales and marketing, which Lemonade defines as their what they're spending on advertising, and add the actual portion of their sales and marketing that they're spending on advertising, because there's a bit of a fixed portion of their sales and marketing that's been around $10 million a quarter, and on top of that, it's been very steady. That's the fixed portion. On top of that, there's the growth spend portion that's been oscillating. So you can see here, quarter by quarter, it was around 20 to 30 million a quarter. It dipped as there was heavy inflation, and they didn't want to grow their business because it wasn't profitable business, because your loss ratios were too high. Then they cut back significantly on advertising, and then they dramatically increased it up to almost 50 million spent in Q2, and they're expecting next few quarters that's going to continue to expand. And now flipping over to this tab, here's what I am forecasting for growth spend for the next 10 years. So we're right here, 2025 Q2, 49.7 million, this little bar, and I'm projecting that they're going to grow this book of business. If they're going to grow 30% a year or more, eventually, by say 2030s, they could be spending over $300 million per quarter in marketing, which would be multiply that by 4. You're talking something between 1.2 to $1.5 billion a year on marketing. But as a percentage of your gross earned premium, I have the growth spend as a portion of gross earned premium. Have it as a red line. You can see this is going to trend down, and I have it going to about 14% range, and then after 2033 I have it declining a bit. The reason this kind of tapers off at the top, and the reason this is improving a bit more here, is because I have the top line IFP, or in-force premium, your top line, how much your whole business premium it has on the book at any given time. I have the growth of that basically doing the 10x from now until the end of 2033, which is roughly in line, or maybe even slightly conservative, on what Lemonade management was forecasting in their investor day last November. And then after that, I have growth rates, still significant growth rates, probably still growing 20% plus per year, but slowing down somewhat. Now they're past the $10 billion IFP book of business, so that's slowing down some, and then the amount you have to spend on growth is not as significant. And then of course if you're spending less on growth, your ratio of growth spend to your earned premiums is going to also decline. But it's a really significant amount. You're talking they'll probably spend at some point in time billions of dollars, billion, and then eventually probably multi-billion of dollars in growth spend in any given year. So really significant amount, but you still see, hey, this is 15% of your total gross earned premiums is getting sent away to this. Now maybe your loss ratio is 65%, so then you have 60% here, or 65% in losses and loss adjustment expenses, and then you have 15% here. You're at 80%, and you still have 20% to do all the rest of the administration for the business and take a profit, which I think is very, very doable at that point. And if we flip over to my model tab right over here, you look at gross spend as a percentage of gross earned premium, you can see it's going down to about 11%. Other insurance expenses had about at 2%. Eventually, like this is, long term, 10 years from now, tech development at 0.8, general administrative at going down about 1%, and total operating, expenses at about 15% versus, say, so 15% is all your operating expenses, but 11% of that is being spent on the growth spend. So most of it's being spent on growth spend. You might say, wow, your projections in your other values for other or tech development or G&A are too low. I would argue potentially, it's hard to say, of course, but I am modeling those at a roughly 4 to 5% growth, which was hinted at as sort of a potential expected growth rate for these all your operating expenses except for the growth spend. So everything else minus the growth spend growing at about that rate, which is what I have it at. That was kind of hinted at Investor Day last November. So, but the point I'm making is, which I think is reasonable too, because if you think about the autonomous organization that Lemonade is building, you should see ridiculous amounts of operating leverage in the years ahead. Now, the point though I'm making though is growth spend's still going to be a really significant amount. It's definitely going to be a very important, significant amount of all the dollars that are spent. And here is a chart of growth spends, the amount you're spending in a given quarter, and then how much IFP you acquired per dollar of growth spend. So the ratio of IFP you acquired plus the growth spend. And this is acquired, meaning this is all the IFP that comes in the door. It's not the net change in IFP, because then you're not factoring in the premiums that are churning away. So it's just all the in-force premium that's being acquired or coming in a given quarter. And you can see it follows this trend line. As you spend more, you tend to have diminishing returns, right? So maybe as you spend more and more and more and more and more, what might the diminishing returns be? It's hard to say. But the advantage is, as they roll out CAR is just a massive, massive monster, ginormous product compared to the other products that Lemonade is in, such as renters and pet insurance. And the car market really is going to dwarf those existing products that they're sort of swimming in right now. And we really don't know the unit economics because they've been very conservative with the car product, because you don't want to roll it out too fast and then have higher loss ratios than you expect, and then you could have some major problems. So they're being conservative, they're being careful, which is the right, prudent, careful, right approach in my opinion. But the encouraging thing to see is the last 3 quarters, Q2, Q1, and Q4 are all bucking the trend line. And then I think we're going to continue to see that buck the trend line even as the growth spend gets bigger and bigger. Say it eventually goes to, $300 million a quarter. You could potentially still have a rate of return that's probably, between 2 and 3 or somewhere in that range. The way I'm modeling right now is long term. If I scroll up here a little bit in my model, is the ratio I'm input right now. And of course you can get this model if you want through my Patreon. It's only $5 a month, and you can play with this yourself, but I'm projecting right now 2.65. So I'm assuming sort of long term across the board, on average, not going to be perfect, but a rough average is they're going to get $2.65 of premium acquired for every dollar they spend on CAC spend or customer acquisition, growth spend. It's all the same thing. So as you do that, again, we don't know what that number could be. Could be even higher than 3 if cars are really rolled out and pushed and as successful as we hope. Could be up there, but this will be a very, very important thing to watch. I will be watching this, following this on my channel with each quarter of data that we get, because I think this is kind of really seen below the hood for Lemonade's financials, and really understanding it at this level will mean we'll know well before the market knows. If there was a problem with something, that the marketing just wasn't working and something dysfunctional in the product, we would start to see it here before the market does. And also the opposite is true. If you see that there's major success, like this starts pushing this up into the 3+ range, even as growth spend gets bigger and bigger and bigger, we're also going to be able to see that. And I'm also going to be able to really highlight and show that. And you won't hear about that on any end. You won't hear about this clearly on any, earnings calls or any other, any sort of traditional analyst coverage or write-ups you'd see on LMND. I think this sort of level of detail you're only seeing on the retail side. So, but that's what my point there is. We're going to know if there was a problem. We're going to know it before the market. If it's even better than we're hoping, which is definitely a possibility, we're also going to know that, I think, well before the market. But right now, the trend is pretty good, even as they're just sort of dabbling in car, and they'll start to roll out and expand car much sooner. One final thing to leave with you guys with is another sort of thought experiment, which would be how much would LMND have to spend on growth just to maintain their current book of business but not grow it in any way. And I did it's not perfect, you can't perfectly calculate this, but you can estimate it pretty close. And I have a minimum growth spend right here, and then I've also overlaid that on top of this growth spend graph, which I'll flip over here. So then you get the same blue as the growth spend over time that I'm forecasting, and then the green here is a minimum growth spend to maintain the book of business. So you can see the minimum growth spend is staying as sort of a portion of your overall growth spend. And the big portion of your overall growth spend is to continue to push and grow the business. As your top line growth slows, this is increasing here relative to the uppermost portion of your overall growth spend. But it's an interesting thought experiment to think, how much would you actually have to spend in any given quarter? And by the end of 2033, you have $380 million total growth spend in that single quarter, but only $158 million is just to maintain customers that might be churning away or leaving the business. So there's always sort of that effect where existing customers are cross-selling, upselling, and growing within the business. And then there's customers that are churning away, and then there's to overcome that sort of the amount that's churning away plus the amount that's cross-selling, upselling, you'd have to spend a certain amount to maintain the book. So I hope this was helpful. The main point, again, I want to make is that LMND is going to spend a lot of money on growth, but it's totally okay, even with all these numbers input in here, depending on the PE values you put in here. Say if you look at the 10% discount rate and whatever at a 40x times the 2032 PE, that means it's worth $142 per share right now. If it's the 2035 PE, because it continues to grow, and then you have a 30x multiple, it's worth $236 right now. If you think those are too high, this should be 30x. Well, now you can argue it should be worth $106, somewhere between $100 to $200 per share. Maybe you think the 2035 PE of 30 is too high, so you make that 20, and you can easily justify with all the numbers and all the marketing that we just looked at built in there, at least at the ratio I used, you could be worth $100 to $158 per share or something in that range. So I hope this was helpful. Thank you so much for watching, and remember, it's in the bag.